The 30-year mortgage, the thing basically every homeowner you know is currently using, is younger than Social Security. It wasn't handed down from some ancient banking tradition. It was invented on purpose by the government in the middle of the Great Depression, because the old system had just collapsed and taken millions of families down with it. Which means for most of human history, and even for most of American history, there was no such thing as a 30-year loan on a house. So how did anyone ever actually buy one? Think about what buying a house means today. The average home costs somewhere around $400,000. The average salary doesn't come close to that in a single year, not even close in 5 years. So almost nobody pays cash. Instead, a bank fronts you the money, and you hand over a slice of your paycheck for the next 3 decades until it's paid off. That system feels so normal, so permanent, that most people assume it's just how buying a house has always worked. It isn't. Before the 1930s, if you wanted a mortgage, you were signing up for something almost nobody would accept today. Here's what an actual mortgage looked like in, say, 1925. You'd need to put down 50% of the home's value in cash up front. Not 20%. Half. Then the loan itself only lasted 5 to 10 years. And here's the part that sounds like a trap. You weren't paying down the balance the whole time. You were just paying interest. At the end of those 5 or 10 years, you owed the entire original loan amount, in one single lump sum, all at once. That's called a balloon payment, and the plan was always the same. When the balloon came due, you'd simply refinance into a new, short-term loan and kick the debt further down the road. That plan worked fine, right up until the moment banks stopped handing out new loans. Which is exactly what happened when the Great Depression hit. Banks got scared, credit dried up, and homeowners who needed to refinance their balloon payment suddenly couldn't find anyone willing to lend them the money. People who had faithfully paid interest for years lost their homes anyway, because refinancing was the one part of the plan nobody thought could fail. By the early 1930s, home ownership rates had cratered, and something like half of all home mortgages in the country were technically in default. So the government stepped in and basically invented the modern mortgage from scratch. Longer terms, fixed rates, small monthly payments that actually chipped away at the loan balance instead of just covering interest. No terrifying lump sum waiting at the end. That single invention is why almost every homeowner today can budget a predictable payment for 30 years, and just how people bought houses in the early 1900s. Go back further, and the picture gets stranger. Before there were banks handing out any kind of home loan at all, most people didn't buy a finished house the way you'd buy one today. They built it, slowly. Sometimes over an entire decade. A family might start with 1 or 2 rooms, made with whatever materials they could gather or afford that year. Then, when there was a bit of extra money, or extra hands to help, they'd add a room, then another. The house wasn't a single $400,000 purchase. It was a project that grew alongside the family's income, piece by piece, sometimes across 2 generations. And for people who genuinely couldn't build or buy at all, there was a version of free real estate that sounds made up, but isn't. In 1862, the U.S. government passed the Homestead Act. Show up, claim a plot of undeveloped land, farm it, and live on it for 5 straight years, and the land became yours. No mortgage, no bank, no 50% down payment. Just 5 years of brutal, unglamorous labor as the entire cost of admission. Millions of acres changed hands that way. An entire chunk of American land ownership traces back not to a loan, but to a government basically saying, if you're willing to suffer through this, it's yours. Now, if you weren't out on the frontier, and you weren't independently wealthy, there was another option hiding in plain sight, one that regular working people actually organized themselves. Groups of neighbors, often from the same church or the same factory, would form what were called building and loan societies. Everyone would pitch in a small amount of money every month into a shared pool. Then, one member at a time, in turn, would get access to the entire pool to build or buy their home. You'd keep contributing even after it was your turn, so the next person could have theirs. It was basically a neighborhood taking turns lending itself money, with zero bank involved. No credit score, no approval process beyond, does this community trust you? That structure eventually evolved into what we now call savings and loan institutions. But it started as neighbors pooling cash and trusting each other to pay it forward. And if none of that applied to you, there was a much simpler, much older method that plenty of people used well into the 20th century. You just rented directly from the person who owned the property and paid them, not a bank, in installments until it was yours. No underwriting, no credit check, just a handshake deal where the seller became your lender. And if you missed too many payments, you lost the house and everything you'd already paid. Here's the detail that really reframes all of this. For most of history, in most places, owning a home wasn't even the default goal. It was the exception. The overwhelming majority of people, for centuries, simply rented for their entire lives, generation after generation, and never expected anything different. Homeownership as a normal, achievable milestone for an average working person is an incredibly recent idea, and it's really only been possible for about 90 years. So the 30-year mortgage didn't just make buying a house easier. It quietly invented an entire idea that didn't really exist before. The notion that a regular person with a regular paycheck could reasonably expect to own the place they live. Which brings the whole thing full circle. That monthly payment that feels like the oldest, most unavoidable tradition in adult life is actually one of the newest financial inventions most people will ever use. And it makes you wonder what today's version of the balloon payment is. Some financial arrangement everyone currently treats as permanent and completely normal, that a future generation will look back on and think, wait, people actually agreed to that?